Top 10 Best Investments. Investing options are many today, and investors may pick the amount of risk they're ready to accept to fulfill their needs. You can choose assets like equities, mutual funds, or ETFs, which are relatively secure alternatives, or you can increase the risk and possible reward by choosing a certificate of deposit, CD. Or you may try a little bit of everything, diversifying your portfolio so that it has a good chance of succeeding in practically any market. Before we start the video, please subscribe my YouTube channel so that you can be updated by my new videos. Number 1. Growth stocks. Growth stocks are the Ferraris of the stock investment world. Excellent growth and high investment returns are what they claim. Tech businesses are frequently growth stocks, although this is not a must. You'll also need to have a high risk tolerance or make a commitment to owning the stocks for at least 3 to 5 years due to the volatility of growth stocks. Risks. Growth stocks carry a certain amount of risk since investors sometimes overpay for the stock in relation to the company's earnings. Therefore, these stocks may lose a significant amount of value very fast in the event of a bad market or recession. It looks as though their unexpected fame vanishes in a moment. However, over time, growth stocks have been among the greatest performers. Rewards. If you can locate the perfect firm, the payoff might be endless, because many of the largest corporations in the world, including Alphabet and Amazon, have seen rapid development. Number 2. Stock funds. A stock fund is a collection of equities, sometimes tied together by a common theme or classification, such as big or American stocks. For this product, the fund firm levies a fee, but it may be quite little. If an investor wants to use stocks more aggressively but lacks the time or motivation to make investing their full-time pastime, a stock fund is a great option. Risks. A stock fund is less labor and less dangerous than purchasing individual holdings. Be aware that your fund will be less diversified than one based on a broad index, like the S&P 500 if you purchase a fund that is not widely diversified, such as one centered on one sector. So if you bought a fund centered on the auto sector, it may be quite exposed to oil prices. Many of the stocks in the portfolio may suffer if oil prices increase. Rewards. Many high-growth equities will be included in a broadly diversified fund that you purchase, such as an S&P 500 index fund or a NASDAQ 100 index fund, in addition to many others. However, you'll possess a more diverse and secure group of businesses than if you only owned a few individual stocks. A stock fund will often be less volatile than holding only a few individual stocks, since you will receive the weighted average return of all the firms in the portfolio. Number 3. Bond funds. A bond fund, whether it be a mutual fund or an exchange-traded fund, ETF, includes several bonds from many issuers. A bond fund's kind, length, risk level, issuer, corporate, local government, or federal government, and other variables are often used to describe it. For investors who desire a diverse portfolio of bonds without having to research and purchase individual bonds, bond funds are a viable option. Additionally, as bond ETFs are sometimes available for less than $100, they are advantageous for individual investors who lack the funds necessary to acquire a single bond, which typically costs close to $1,000. Risks. A bond fund will be reasonably steady even if bonds can vary and may move in reaction to changes in the current interest rate. Compared to stocks, bonds are thought to be safer, but not all issuers are created equal. Government issuers, particularly the federal government, are seen as being fairly safe, whereas business issuers might be anything between somewhat less and much more dangerous. Rewards. One of the safer investments is a bond, and when bonds are included in a fund, they become even safer. A fund diversifies its assets and lowers the impact on the portfolio of any one bond defaulting, because it may own hundreds of various bond kinds from several different issuers. There are several fund options to suit your demands if you're looking for a bond fund. Number 4. Dividend stocks. Older investors like dividend stocks because they provide a consistent income, and the finest firms raise that dividend over time, allowing you to earn more than you would with a bond's set distribution. One well-liked type of dividend stock is REITs. Risks. Even while dividend companies often have lower volatility than growth stocks, don't think they won't have substantial ups and downs, particularly if the stock market experiences a difficult period. However, if a dividend-paying firm doesn't make enough money to cover its dividend, it will reduce the payout, which might cause its price to fall. Rewards. The big appeal of a dividend stock is the payout, and some of the top companies pay 3 or 4% annually, sometimes more. But importantly, they can raise their payouts 8 or 10% per year for long periods of time, so you'll get a pay raise, typically each year. Number 5. Value stocks. The values of several stocks have inflated during prolonged market gains. When that occurs, many investors look to value stocks as a way to play it safer while still having a chance to generate significant returns. Given that value companies often do well when interest rates are rising, they may be a desirable investment in 2022. Additionally, the Federal Reserve has been swiftly hiking interest rates this year. Risks. Value stocks tend to fall less when the market declines because they frequently have less downside. They can still increase if the market does too. Rewards. If the market starts to prefer value stocks again, their valuations may climb more quickly than those of other non-value firms. Value stocks are appealing because they offer above-average returns while posing lower risk. Number 6. Target date funds. If you don't want to manage your own portfolio, target date funds are a fantastic alternative. As you become older, these funds grow more conservative, making your portfolio safer as you go closer to retirement and will need the money. Although you may purchase target date funds outside of 401k plans, they are a popular option in many employment plans. The fund handles the remainder when you choose your retirement year. Risks. Since target date funds are really just a blend of stock funds and bond funds, they will carry much of the same risks. Your fund will possess a bigger percentage of equities if your target date is decades away, which means it will be more volatile at beginning. The fund will move more toward bonds as your goal date approaches, resulting in less fluctuation but lower earnings. Rewards. Some financial advisors recommend buying a target date fund that's 5 or 10 years after when you actually plan to retire so that you'll have the extra growth from stocks. Ultimately, what the fund is invested in drives your returns. More stocks should equal a higher long-term return, while more bonds should equal a lower long-term return. Number 7. Real estate. Real estate is in many respects the archetypal long-term investment. Starting off costs a lot of money, fees are exorbitant, and profits are frequently obtained by owning an asset for a lengthy period of time rather than just a few years. Nevertheless, a Bankrate analysis found that Americans' preferred long-term investment in 2022 remained real estate. Risks. You increase the risk of an investment succeeding whenever you borrow a sizable sum of money. However, even if you pay cash for real estate, you'll still have a lot of money invested in just one asset, and a lack of diversification might lead to issues if the asset is damaged. Rewards. While the risks can be high, the rewards can be quite high as well. If you selected a good property and manage it well, you can earn many times your investment if you're willing to hold the asset over time. Number 8. Small cap stocks. Even though buying individual stocks involves extensive research, small caps might be a terrific area to locate the opportunities that other investors have overlooked. However, investors need to have a steel stomach, because these little fry tend to be far more volatile than larger, more well-established enterprises. Risks. Small-cap firms are notoriously unpredictable, and their stock prices can change drastically from year to year. In addition to the price fluctuation, the company is often smaller and has less financial resources than a bigger one. Small-cap firms are therefore thought to have higher business risk than medium and large-sized businesses. Rewards. You may potentially discover 20% yearly returns or more for decades if you're able to purchase a true hidden gem like Amazon before anybody can really realize how big it can eventually become. Finding a successful small-cap stock has enormous potential rewards. Number 9. RoboAdvisor Portfolio. You just deposit money into a RoboAdvisor's account, and the system will invest it depending on your objectives, time horizon, and risk tolerance. When you first sign up, you'll be asked to complete several surveys so the RoboAdvisor can learn more about your needs and manage the entire process. The RoboAdvisor will choose investments for you, generally low-cost ETFs. Risks. Robo-risks advisors are heavily influenced by your investments. You might anticipate greater volatility if you invest heavily in stock funds due to your high risk tolerance than if you buy bonds or keep cash in a savings account. Risk thus lies in what you possess. Rewards. A RoboAdvisor will frequently create a diversified portfolio so that you have a more steady sequence of annual returns. But that comes at the expense of a somewhat lower total return. Number 10. Roth IRA. The greatest retirement plan available right now could be a Roth IRA. It enables after-tax savings, long-term tax-free growth, and tax-free withdrawal of your money. It's an appealing substitute for the conventional IRA since you may leave that money to your heirs tax-free as well. Risks. An IRA CD is a fantastic choice if you are risk-averse and desire a guaranteed income with no potential of loss. Simply a CD inside of an IRA constitutes this investment. When the CD matures, the chance of not getting your payoff and your principal is virtually non-existent. Although you still need to be cautious of inflation, it's nearly as safe an investment as there is. Rewards. If you want to step it up a notch, you may invest in stocks and stock funds and take advantage of their potentially much larger returns, all while doing it tax-free. You must accept the additional risks that investing in stocks and stock ETFs entails. I hope you find this video helpful. If you liked the video, please like and subscribe as it really helps our channel, and remember to give your feedback in the comments below. See you in the next video with some more interesting topics and facts.